This is JJ Winrick with teachingkidstobuystocks.com. Let's talk about bonds. What are bonds, you ask? Bonds are loans. Organizations of all types will borrow money from investors by issuing bonds. Countries, state and local governments, companies will all issue bonds as a way to finance their activities. So here's how it works. To start, bonds are sold to investors, usually in increments of $1,000. This will entitle the investor to receive interest each year until the maturity date. At the maturity date, the investor then receives their $1,000 back. So let's use an example of a new bond offering with the city of Springfield. And so the city of Springfield issues the bonds today to investors. Each year, the investors will receive interest for that investment, and then at a date in the future, the maturity date, investors will get their principal back. Interest paid to investors is called the coupon, a term which dates back to when bonds were issued in paper certificate form, and investors would tear off a coupon from their certificate, take it down to the bank, and trade it in for cash. The coupon is expressed as a percentage of $1,000, so 5% of $1,000 is $50. This bond pays $50 a year in interest. So back to our example, if the bond were issued today, the investor would buy it for $1,000. Each year, they would receive $50, representing that 5% coupon. And then at the maturity date in the future, the investor would receive their $1,000 back. Bonds can be bought directly from the issuer at the time of creation, as in our example, or they can be bought and sold in the marketplace. Market prices will fluctuate based on the supply and demand for the bond. Bonds that are trading for more than that $1,000 maturity price are said to have a premium, and bonds that are trading for less than that $1,000 maturity price are said to have a discount. For example, let's assume you can buy that Springfield bond for $900 from another investor. So you would pay $900 today. Each year you would receive $50, that 5% coupon. Remember, it's 5% of $1,000. And then at the date in the future, the maturity date, you would receive your $1,000 back. So if you held the bond until maturity, then you would make an additional $100 profit on the bond in addition to the interest that you'd received. You're also making more than 5% interest on your investment per year because remember, you only invested $900. So if you do the math, you're actually making 50 divided by 900 is 5.55% per year in interest on your money. This doesn't include the $100 that you would make on the difference between what you bought it for and what it matured at. So your total return on a bond investment is the interest that you receive, as well as the gain or the loss on that principal, the difference between what you bought it for and what you either sold it for or what it matured at. Going back to our example, calculate the total return. If you paid $900 for the bond, you earned $50 in each of 8 years for $400 in interest, then received $1,000 back at maturity. You made $500 on the total investment, which if you calculate that as a percentage, 500 divided by 900 is 55.5% total return. Without taking you into the math behind it, that's roughly the equivalent of earning 6.6% per year in interest. Now let's change the scenario a bit and assume you pay $1,100 for the bond. Today you pay the $1,100. You receive $50 each year, and then at the maturity date, you get $1,000 back. You'd still receive the $50 interest each year, and you'd still receive your $1,000 back at maturity, but it looks like if you held to maturity, you would actually lose the $100 from your original purchase price. This doesn't mean you lose money on the entire investment, but you certainly earned less than the 5% coupon rate. So your actual interest given an $1,100 investment is $50 divided by $1,100 equals 4.55% interest. But this doesn't include the $100 you lost on the difference between what you bought it for and what it matures at. And that's why we calculate the total return. Total return would be our $400 in interest minus the $100 that we lost on the difference between the purchase price and the maturity price. If we take that $300 divided by our $1,100 purchase price, our total return is 27.3%. That's roughly the equivalent of earning 3.5% per year for the 8 years in our scenario here. Watch for bond lesson number 2 coming soon, where we will cover some of the reasons bonds move up and down in price. Thanks so much for watching.